Why is understanding the global macro landscape crucial to not only our thematic investing lens at Thematica, but to regular investors and businesses as well? Today, Lenore Hawkins, Thematica's chief macro strategist, will provide us with those answers and so much more coming up on this episode of Cocktail Investing. Welcome back, old listeners, and welcome new ones to the Cocktail Investing Podcast, where we aim to distill all the noise around us into clear investing signals. I'm Chris Versace, Thematica's Chief Investment Officer, and joining me, as always,
is me, Lenore Hawkins, Chief Macro Strategist.
Were you having second thoughts there?
How smooth was that?
That was way smooth. Hopefully that's the one hiccup that we have today. So anyway, as you know, Lenore, I was thinking about this, getting ready for this podcast, because we're going to talk about all that you do, looking at the thematic tea leaves and through the global macro landscape. But I can't believe that this is our 55th episode of the podcast. I was just thinking about that. That's quite some commitment, don't you think?
That seriously is.
Yeah.
Well done.
So for new listeners, welcome. And if you want to go check out past episodes of the podcast, you can head over to thematicaresearch.com. That's where all our wares are. Everything from Lenore's fantastic weekly wrap to the Monday morning kickoff to our premium products and a whole host of other things. And again, that's thematicaresearch.com. So, Lenore, in keeping with the notion that this is our 55th podcast, a couple weeks ago, I think when we hit 52, I was thinking, way back to the very first podcast or the first couple. And, we kind of jumped into the pool, almost with no clothes on, if you want to think of it that way, because we just jumped into it and got started.
Okay.
You know what I'm saying? You know what I'm saying?
That is a way to look at it.
I'm just saying we didn't exactly lay the groundwork for who we are, how we look at the world and all that kind of stuff. We just jumped right in. Which, is kind of the way that we operate a little bit. But having said that, I think that as we enter into our next year, it probably makes a little sense to explain a little bit about how we see the world, why we see it the way we do, those sort of things. So you're in agreement?
Absolutely.
Excellent. So lucky for you, you drew the short straw on today's episode.
Yes,
so we're going to talk all about global macro and why it's crucial to not only our thematic lens, but to investors and business folk everywhere. And I strongly suspect that we'll uncover some of what makes you tick and how you see the world as well. And I can say that full well knowing
God help us all.
Well, yes, that is true. But I also say that full well knowing that you don't know what I'm going to ask you as I put you under the cocktail investing microscope. So are you ready, Lenore?
As ready as I'll ever be.
All right. Well, then here we go. Let's set the stage and, talk to the listeners about what you were doing before you joined Thematica.
Before Thematica, I was had splitting my time doing two things. One was being a investment advisor for our high net worth families primarily in the West Coast, and then doing consulting work in Europe for more the ultra high net worth families when they're dealing with Americans for a variety of different transactions.
Okay. Now, how important was looking at the not just the economic landscape, but really the global macro landscape in all of that?
Well, having effectively boots on the ground in the two areas, particularly when I started doing this back in, because I first started coming over to Europe in 2012. And it was really interesting to be here and see how, because most of the time I'm in Italy, how Europe was really behind the U.S. as far as coming out of the financial crisis. Europe went into the recession later, and they came out later. Mm-hmm. And Italy in particular has lagged a bit more than Germany for a variety of reasons. And it's very useful when you look at the world with a global kind of macro perspective. It's very useful to actually experience it, to have it on the ground.
Why
rather than just reading it?
Now, why do you say that it's important to understand essentially the global economy from your perspective?
First off, why do you even need to understand the economy, right? When you're investing, who even cares about the economy? Because there's actually quite a few investors. There's many investors who'll say, who cares? They don't really look at the economy at all. They just look at specific stocks, and that's all they really care about. The economy is sort of irrelevant to them. Mm-hmm. And I can see that perspective. If you really want to just focus on specific companies and all you care about is like there is a catalyst for this particular company, for example, and there is an argument to be had for that, but you're ignoring exogenous factors that are going to have an impact on share price, right? There's no way to get around that because as you and I talked about, we talked about this in our book Cocktail Investing, you can think of the economy as the seasons.
Yep.
And within seasons, you can have a unseasonably cold day in summer or an unseasonably hot day in winter. But the season is still the season. It's still winter. It's still summer.
Right. And just keeping with that, different parts of the world have different seasons at the same time as we have here.
Exactly. Yeah. Like exactly. The whole world does not follow the same seasonal cycle. They do follow the same seasonal cycle, but they're not in sync with that.
Right.
Although we have been seeing more and more as global trade has become more and more integrated, and as the global pipeline has become more and more integrated. For example, like you look at a car, and cars typically, the parts in a car come from a ton of different countries.
Yep. Same thing with smartphones and all sorts of products.
Most products that we buy, particularly those that are a little bit more complicated, they actually come from a lot of different countries. And as we see that happening, more and more of the world is getting more interconnected. So you do see more of an in sync economic cycle. It's more in sync than we used to have, which has its pluses and minuses. When things are going well, it's great. When things aren't going so well, it's a little tough because we used to have, when they were more out of sync, you could at least have some other countries that are, they're having a summer when we're having a winter, and
Correct.
that could kind of help balance things out. But if everybody's in sync, it's a little bit more challenging. So now back to, why do you even care?
Yeah.
Well, if you understand what's going on in the business cycle, right? Like, are we just coming out of a recession? There's kind of rules about which sectors do best at different phases of the economy, different phases of the business cycle. And it also kind of, it gives you what we always talk about, you and I talk about, is the headwinds and the tailwinds, right? So if you're right, like for example, right now, I think we're very far along in this business cycle that we're maybe not ninth inning, we're like bottom of the seventh, eighth.
Now let me just clarify. When you say the business cycle, you're talking about the business cycle in the U.S.
Yes, the business cycle in the U.S. Yes, and I think we're kind of like bottom of the seventh, eighth,
seventh inning stretch.
Seventh inning stretch, exactly. I would say that Europe is more like fifth, sixth. They're definitely further behind, and that gives you a perspective on what kinds of sectors are going to do well, and also gives you an idea on kind of timelines you've got, right? Like if you're early, really early, like it is the first inning, right? Because we're just starting to come out of a recession, and when you see that happen, your PEs are really low, right? Prices, everybody's just gone, oh hell, I'm out. And when you look at that, you're going to have a very different perspective on how long you consider holding something, because overall, things are going to go up and down. It's not a straight line. But when you're just starting off, like say March of 2009 or even like January of 2010. Now it was bumpy along the way, but you knew that you have at least say 4 or 5 years that the economy is most likely going to continue to kind of move along. You're not going into another recession.
Perform, if you will.
Performing, right. But always paying attention, because you never know, things can happen.
Let me just pause right there, okay? Because I want to take what you're saying there about realizing maybe when the end of the business cycle is near or when the start of the business cycle is coming. But I just want to dial it back a little bit, because I know, having worked together for so long, I know how excited you get by all the economic data and everything else. And I have to ask, was global macro or studying the economy always of interest? Because I don't think people are out there when they're playing with their action figures or dolls or playing softball, baseball when they're 9 and 10 going, I'm going to study the economy.
Yeah, oddly enough, I was really kind of dorky about that. I really was. I remember the first time I started thinking about the economy and having kind of any appreciation for it was as a kid, as a little kid, and Reagan got elected. And I didn't really understand, as a child. So I had no idea the economy meant or what politics were, like left, right. The hell did I know? But I knew that in my little town, everybody was kind of bummed. Like it just seemed like the world was a tough place. And I just had this sense, like my family was fine. We weren't struggling. I was very fortunate, but I could see around me that people were really struggling. And then it was, I think the Reagan election was the first one where I was old enough to kind of have any kind of awareness.
Inkling.
Yeah, exactly. Because I remember there was a whole thing with the Iranian embassy, and the U.S. was just devastated that we had Iran make us look so weak, and then we had the election, and I started seeing people getting really optimistic, and people were cheering, things are getting better, and this is really interesting. Like, why?
Right,
I wanted to understand why. Like, what was so bad then? And why is everybody happy now? And then we had like a pretty solid run there where things just kept getting better and better and better. And I kept wanting to understand why. And I'd asked my mom and dad and they gave me some interesting answers. And
I can't even imagine what that means.
My dad was a lawyer and my mom was an English major. So they had a very different perspective than I eventually came to have studying economics. I mean, very good answers, but just a different perspective. And then
maybe they didn't have the answers, is what you're saying.
When I went to college, I started off thinking that I was going to get a degree in engineering and in math. And instead, I got a degree in math and one in economics because I wanted a system that was just more complicated. And for me, the economics is a system that is endlessly complex. Right?
This is one of the ways in which we're similar, because I shared the same double major, and I hadn't really thought about it until years later. But the ability to take all the graphs and charts that you were creating in math and superimpose that on top of some of the early microeconomic charts that you would have that would actually be, I'm just thinking this through in my head, maybe like 4 charts kind of stacked to each other and and doing all that. So well,
it's interesting because it's to me, economics is such a complex equation, right? It's basically a equation with almost infinite variables with coefficients that are constantly changing. I mean, that's really interesting. And it's also very much a study in human psychology, which I think is also really interesting. And that's part of where those variables are constantly changing, because it's an awful lot of how the economy functions in like the near to midterm is more about the thing that everyone knows to be true. And I'm innately a bit of a contrarian.
That is true.
That's true. I'm one of these people like getting off a plane. It bugs me. It really bugs me getting off a plane and walking in the same direction as everyone else. It irks me.
That's why
I do it because
no. What you have to do is you have to fly like I do. You have to fly those flights that let you go out the back of the plane. They do. They exist. Anyway. So ultimately you were fascinated by how all of this works, right? And trying to study it and understand it, and as you said, why it is the way it is. And I think what you were finishing up there before I got you off track, it is what is, as you like to say, what is the prevailing narrative and how right is it or not?
Yeah, exactly. And what happens when the thing that everyone knows to be true, everyone decides or suddenly comes to the shocking realization that it isn't true.
Exactly.
What is going to happen then? And what is it going to take? Like, what would be the thing or things, right? What are possible things that could happen that would make everyone go, uh-oh, maybe that's not the case.
Exactly. But I have to say, you also do a very good job of digging into the data so that when there is that freak out moment, you're able to put some context and perspective around it and perhaps what the herd sees as a freak out moment is not really a freak out moment. For
Right.
example, like what you did coming out of the January employment report, when everybody freaked out over that wage figure, you were the first person I remember seeing digging into other data that said, yeah, it's only for 18% of the people. It's not 82%.
Yeah.
It's not what everybody thinks it is. So
And
that's
eventually, everyone kind of realized that, and they were looking at inflation numbers then too, and people are, oh,
yeah, exactly.
this is like, no, dig into a little bit deeper, and it's one of those things that I think is really interesting about understanding the economics and applying that to the markets is it helps you really weed through, like when I talk about the noise.
Mm-hmm.
Because you do tend to get those headline numbers come out, and that is so much noise. And if you respond to the noise, you're just going to make yourself crazy.
No. I mean, we have said between us for a long time that you've got to dig beneath the headlines and get, as you like to say, get into the data and really see what's going on. So,
And I think it's particularly important and challenging these days because in the era of social media, and the problem, I think one of the biggest problems with social media is social media has everyone, including the official media outlets, but it has everyone racing to be the first one to put out, here's our perspective on this piece of information that we just got, right? Everybody races for it. And the goal is to be the first out or the fastest out, not to have the most thoughtful analysis. Because I'm sorry, you cannot have a thoughtful analysis of something in like 10 minutes.
Or 60 seconds.
Yeah, and that's what, because a lot of them, they prep, right? Because you did not write that whole thing in like the 3 minutes it's been since that data was released.
Right. Okay. All right. So let me see if I can get us back on track now. So you were talking about the business cycle, where we are and such, as well as identifying potentially the end as well as the beginning of the next business cycle. So just for the listeners here, looking at the world as you do it, the amount of data that you do, how do you do that?
Well, it's combining a lot of different pieces of data. So one of the ways I look at that, I look at the three, what we talked about in cocktail investing, the three really the components are kind of, you can think of them as the three major participant groups in an economy. And it's pretty simple. You have the government, you have households, and you have businesses. Now, the relationship between those three tells you a lot about what's going on in the economy. For example, when everybody recently, past couple of years, people have been talking about at various times, like how great the corporate sector is doing. And then I go look at corporate tax receipts and see if the corporate tax receipts are telling me the same story. Now, sometimes they have, and sometimes they've been telling me a very different story. And that could kind of give you an idea of what's going to come up in the future earnings and so on.
Right. As I recall, that is page, I think, 62 of the book Cocktail Investing, where you laid out a very great diagram explaining the inner workings between households, businesses, and the government.
I was actually really proud of that picture.
That was
I put that picture together myself.
I know. That's why I said it. Yeah. I mean, it's it's funny. I don't mean to cut you off, but I'm thumbing through this, and there's a lot of stuff in that book.
Yeah, it's a long book. We wrote a pretty long book.
detailed book. But I'm sorry, you were saying.
So one of the things, if we're looking at households, what I'll be looking at there is typically at the kind of early on in a cycle, which is the first sprouts of spring. So we've just gone through the winter of a recession, and we're starting to see the first sprouts of spring. How do I know that that's happening? Well, during the winter of a recession, households are freaked. Everything's going to hell, right? So people are they're not increasing their credit card debt, right? They're going, okay, we're not spending. I'm cutting back.
Right.
I'm trying to reduce my debt because I'm scared. I don't know about my job, right? I'm really nervous. And particularly, I like to also split apart the data, the data that we get on earnings, because a lot of that stuff is all like household earnings, the weekly average earnings or hourly average earnings. A good way to look at that is to break apart the two main categories. There's one that is represents about 82% of the population. That's the production and non-supervisory.
Right.
And those are people that are kind of the lower income earners. And then you have the rest, right? And that part, those are salaried people.
Mm-hmm.
And just looking at the salaried people and average earnings there doesn't tell you that much. So I actually like to get them out of the data. They may get fired, right? Because we can go into a recession and they may lose their job, but that's not really affecting the average earnings. They're fired. So they don't count in it. They may get a pay cut if things get really bad, but it's not as reflective as if you're looking at people who are that production and non-supervisory, because they actually get paid based on the number of hours that they're working, and their pay is a lot more flexible, their pay scale.
Well,
so that tells you more about what's going on there. So I like to look at those guys, and I look at their debt levels. I look at what's going on with credit card debt, with spending habits, and with income relative to their household debt.
Okay. Do you look at the number of hours that they're working as well?
I look at how that's changing.
Right.
And I also look at the part-time, like the temp jobs and part-time, because typically when companies are really nervous, they're not going to bring someone on full-time.
Mm-hmm.
The pattern is usually they'll start going out and looking for temp staff.
Mm-hmm. Well, I think
I
think first you see overtime kind of pick up, right?
Yeah, you see overtime starts to pick up a little bit. You see hours start to increase, and then you'll see them bringing on some temp staff.
Right.
You see those hours starting to increase, and then eventually they'll start bringing people on full time.
Mm-hmm.
So I start looking for these hints. What gets me nervous is when I see, like in the most recent report we just got today on hours worked, actually had production and non-supervisory hours worked went up. So that means we're still in an expansion. When I start to see that, although I mean it's always one of our mantras is it's only 1 month.
Right.
So we look for trends, but we have not, the hours worked has not been consistently moving up. This week it moved up. This month it moved up quite a bit. It was like 0.6. So that's a pretty big jump. I'll see what happens next month because it's been kind of flat, not moving a whole lot, but that was a pretty good bump up.
So what I'm hearing you is there's this constant need to check and refine. Right.
Yeah.
So, it's
build a hypothesis, look to see if you have corroborating data.
Okay. So so to me, what you're saying is it's not always easy to read the tea leaves. Sometimes you might get a clear signal over a period of time with data. Other times you might get mismatching data. So I guess the question for me is when you're looking to distill a signal from a lot of this noise, how do you keep yourself in check? How do you, retest what you're thinking?
By looking for the more confirming data points I can find, the more confident I am.
Okay. And is there?
This is all a game of probabilities. Like nobody can know. There is no absolutes out there, which is something that I like, although it's definitely challenging, right? Because and it's one of those jokes about, if you have 4 economists in the room, you'll have like 6 opinions.
Right.
Because we're always going like, on the other hand.
Yes.
But that's really, it's not that economists are trying to be all wily. It's that the reality is you can't know, and it's constantly moving. The economy is a living, breathing thing. It never stops. It's never in a specific state. And you never get where every single data point is going, absolutely, this is it.
Right. I mean, you said it, I think, earlier when you said that, the economy is a living, breathing thing. And what's fascinating to me about it is that there are things that happen that alter, the structure. Right. So it's something new, some other form of potential disruption that has a ripple effect through industries and stuff. So it's always interesting to think about how that is reflected in some of the data. For example, like let's say retail sales, right? One of the fastest growing categories is non-store, right? But people are spending, but there's that shift in spending. What does that mean? How are they spending? Why are they spending? All that kind of stuff that you write and talk about all the time.
Yeah, and there's always questions to look at too, like, well, why are they shifting more online? And it's not something as straightforward. You can't just assume, well, because they can, right? That's
right.
Yes,
there's something.
True, but what is so compelling about online? And then we look for other things that are happening that can kind of explain it. And when you look at online spending, one of the things that online spending gives you is that it's really, really easy to check prices.
Yep.
And if we look at what's been going on with income levels, income levels have been growing at a slower and slower and slower rate, decade after decade after decade. And it's been a pretty tough go. So with that, obviously that's our cash-strapped consumer investing theme. And that ties in really nicely with the connected society investing theme that is all about how easy it is to check for prices online, to buy things online. So you get those two kind of coming together, and that's one of our great, the way we look at investing. When you get two or more of our themes working in the same direction, you have an even more powerful theme. But that those themes kind of come from not just because they all come about the disruptive technology of the internet, right? So that is more of you could call it like a company specific, a sector specific when you're looking at the disruptive technology. But if you really want to understand what's going on, you also need to understand the economic side. And the economic side is, for example, is that income has been growing at a slower and slower pace, leading to that cash-strapped consumer. And at the same time, we've seen debt going up and up and up.
Yeah, I think what you're talking about here is you're kind of pulling on the string of explaining different aspects of the why.
Yeah.
And if you can understand that and what the ramifications are of the data, then you can start to figure out those types of companies that are helping solve the problem. Right? So it sounds to me, though, that there is no shortage of data to look at.
Oh, yeah.
Right. So are there any tricks, apps, sources, anything like that the listener here can go, wow, instead of looking at this sea of data, there's some place that helps me refine it down into something a little more digestible? Or is that not the case?
Well, our website.
There you go.
Informatica research. We talk about it a lot. But
right.
Yes.
Fair enough. Fair enough.
But outside of that, actually, one of the things
I really walked right into that one, didn't I?
Yeah, you did. And we didn't even. I swear to God, listeners, we did not set that up. One of the data sources I actually really like is the St. Louis Federal Reserve's FRED, because it makes it really, really easy to look at charts of data. So you can look at something as simple as like household debt to GDP. That's kind of an interesting one to look at. You can look at total stock market capitalization to GDP. And these are things that can kind of give you an idea, like, where are we? Because like we've talked about in the economy, you have cycles. We also have cycles in the stock market, right? We have these bull markets, and the bull market has similar attributes to the economy cycle in that it starts off very stressed, a little bit, right? Right. Winter was tough, man. I'm seeing some green shoots, but I'm not entirely buying it, right? So it goes along. And then when you get into that heat of summer, like you just start going gangbusters. Woohoo!
So having looked at the St. Louis FRED data, right, myself, do you like it because it allows for an easy graphical representation?
Yeah, I think it's a lot easier to be able to see things visually. Like just looking at a row of numbers is it's very difficult to understand patterns out of that. One of the other pieces of data I find really interesting is to look at the Citibank Economic Surprise Index, because that kind of takes two things. It takes a look at what data we're actually getting, what the direction of the data, versus the emotions. Right? Because the stock market operates on emotions. And
I would say it operates on expectations, whether they're met or not.
But that's a very expectation is it kind of comes from an emotional, like you have a fact.
Well, it's like Christmas morning.
Yeah, exactly. And if I'm seeing the Citibank Economic, it looks at what really happened versus what everybody expected to happen.
Exactly.
And if I see that what really happened was better than what everybody thought to happen, I'm like, okay, we got room to run, right? We got to move up to the upside, right? Because people are not nearly as optimistic as the reality is. And if I see that keep happening, I'm feeling pretty good. Now, when I see it start to roll over, and what that means is that the data coming in is not as good as was expected. And if it keeps doing that and it starts really moving down, like, okay, people's hopes are out of whack with reality. They're way too optimistic. And if I take that and then you look at what's happening with PE ratios, there you go, right? You've got PE ratios are priced for perfection.
Correct.
Because those tend to go together, right? Where people are expecting the economic data to be fantastic. They're willing to pay a lot for every dollar of earnings.
I hear you.
Put those two together and it gives you a good idea of where the market and the economy kind of intersect.
Now, you were saying before, you referenced that joke about 4 economists, 6 opinions. And I would say that I think, if I remember my degrees correctly, the one in economics is a BA, Bachelor of Arts, because it's not exactly an exact science, right?
Yeah.
Right. So, this has happened to me and you've seen it. Sometimes you can expect the data, or you're reading into the data and it can say, you think it's saying one thing, doesn't always say that. You can be wrong. What's the biggest mistake that you've made as a person trying to read the economy? And what did you learn from it?
Yeah, I think my all-time biggest mistake would have to be, it was when we started all this quantitative easing. Mm-hmm. Because I really underestimated how powerful that spigot could be, how long that spigot was going to run, and how much everybody was going to believe, and how extended it could possibly get with believing that the Fed has the markets back. Right? I didn't see it. I thought that people were going to look at this more, because when they started doing the quantitative easing, everybody was talking about inflation. Like, right. This is going to be really bad, right? There was a lot of talk around that, and I looked at that and thought, yeah, there's a case to be made for inflation, but my big concern, because I think inflationary forces, yes, they're there, but they're more short-term inflation, because we've got way too much debt out there to really get inflation going gangbusters. But I underestimated, and my error was I kind of fell in love with my thesis too much, which is
you can't do that. You can't fall in love with it. As an investor,
that's like the worst thing you can do. But we were, in my defense,
we were in uncharted territory. Yes.
Right, we're really in uncharted territory. So it was difficult to kind of take any lessons from the past. But what I should have leaned on was, when you have, the past does show you that when a central bank wants something to happen, it's going to happen. Now, eventually it tends to end in tears.
Right. Well, that brings back to don't fight the Fed, right?
Yeah, exactly. It was a don't fight the Fed. And then add in, well, don't fight the Fed and the European Central Bank and the Bank of Japan.
Don't fight central bankers.
Yeah, I mean, they all got together like, all right, we are hitting the accelerator pedal.
Okay. So how would you, going forward, try and prevent that same mistake?
I think what I was doing was looking too far out, and that's one of the challenges of macro. Like, macro kind of has to, you need to know it, but you also need to be able to take it and put it to the side and go, okay, well, what is happening the here and the now over the next, say, 4 or 5 months? Mm-hmm. Because the challenge with macro is it is so high level, it is so big picture, that you can say, like, I see this on the horizon, but that horizon can be like 12 to 18 months.
Right.
And within those 12 to 18 months, you have missed some great investing opportunities.
Mm-hmm. Well, that's why I'm here.
Yeah, exactly. No, that's why listeners, that's one of the reasons we work together. Because I'm like, wait, no, look up here. And Chris says, no, look down here.
Exactly. So,
so to not do that would have been more just, okay, like month to month, what are you seeing? What is the delta month to month? And had I focused a bit more on that rather than the big, 10,000 foot level, I would have seen that my hypothesis was, it was just too long term, because that's one of the challenges with macro. It was like, is this something that's gonna come about in like 18 months, or is this maybe like a 5-year thing?
Well, that strikes me as, I mean, that's kind of tough, because you're what I'm hearing you say is you need to balance looking at the trees for the forest, but also having your eye on the forest for the trees.
Exactly, because you can just fall too if you do towards kind of lean towards the economic side, you really can just you're seeing the forest and you're not seeing what's actually going on with the trees, and you miss opportunities and you can miss some risks.
Okay. So as you put as I don't think I've used this term in some time, high priestess of global macro hat on. What's the easiest aspect of the economy for the average investor, the average business person to kind of understand in your opinion?
I think for any particular, the best way to really understand kind of what's going on, take monthly data, take a look at how much people are earning, take a look at how much people are borrowing, take a look at what's happening with the revenue on businesses. I get a little nervous with EPS because that stuff is so easy.
Well, between buybacks, taxes, one-time items, and all that other gobbledygook. Yeah.
Yeah, I'm a much bigger fan of revenue and EBITDA. But if we're looking at like household income, household debt, look at like 3-month moving averages.
Okay.
Because that, month to month
smooths the trend out.
Yeah, exactly. Month to month stuff, that is just noise. It doesn't, and sometimes that data can get so perverted. For example, when we have those massive, like last fall was just brutal. We had the fires, we had a hurricane.
Oh yeah.
That just really messes the data up, and it almost becomes completely useless data. So you have to keep that in mind. To take those crazy things out, just ignore it. But if you look at 3-month moving averages of stuff, you can get a much better feel for how things are doing. And it's always a good idea too to take a step back. And this is one of the reasons I like the Fred data, is to also look at other business cycles. So look at what happened. Like if you're looking at, say, the 3-month moving average of personal consumption expenditures, look at what the 3-month moving average trend was when we came out of the last recession. Look at what it was happening with it as we were kind of heading into the next recession.
So this is where using the St. Louis Fred and those charts kind of comes in handy.
Yeah, exactly.
Okay. What, as you've talked with people, whether it's on other radio programs, TV shows, what have you, what's the hardest thing for the average person to grasp about the economy?
It's a really good question. God, there's a lot. I think actually the hardest thing for the average person to grasp is that it is not the headlines, because you are bombarded. I think it's very difficult as somebody who doesn't like actually love this stuff and get into the data to have any real feel for what is going on in the economy when you are constantly bombarded with pseudo-economic information.
So give me an example of pseudo-economic information.
Economists are concerned that inflation is on the rise.
Yeah,
right. That's a headline.
Correct.
Right.
Okay.
You get that headline, and you're like, "Oh crap, inflation." And you hear enough of that, and that's actually you can see these headlines coming through, and they'll be like completely contradictory within like 10 minutes from different sources. Right. But if you only catch the inflation rising and you don't catch anybody else saying, well, let's look at this a little bit more in detail, you can very easily come to a mistaken hypothesis, and then you start taking action based on that hypothesis, because looking at the economic data is actually, it does take some time to actually read these. And if you're going to read them and understand them when you've never done it before, it takes even more time.
I was just going to say that, taking the time out to understand what the underlying data is saying, what the trend in the data is, that you can't do that, as we were saying earlier, in a quick tweet 60 seconds after something happens. What
I recommend is you find somebody, find a group, find a person, find somebody out there who you resonate with them. Like you like the way that they're analyzing stuff. It makes sense to you. and go first to them, see what they say, and then go to try and double check it. Just see it as, can you back that up? Can you find where what they're asserting actually makes sense?
So what I'm hearing once again is go to tomaticaresearch.com, read what Lenore is writing, and see if she's right.
See if that makes sense. Well, it is. I mean, for investors, most investors, unless you're really, really lucky and you've made your fortune and you're 35 and you quit work, you have a job. You're busy.
Yeah,
you have a family. You have a job. Trying to understand what's going on in the economy and keep on top of your portfolio is incredibly time consuming.
Those are 2 full-time jobs right there.
Yeah, they really are. Trust us, because we do them.
Yes. All right, let me move along, because I know we're running a little long here. What is it in your view that the herd gets most wrong about understanding the global macroeconomy?
That the United States is no longer the center of the universe.
All right, so hang on. I just want to be clear on this. You're saying that a lot of people still think the United States is the center, and it's not.
And yeah, it's really not. That we are not. That is changing, because for basically everyone alive right now, the U.S. always has been. Mm-hmm. The U.S., when you look at global GDP and you look at the U.S. GDP, they're like super correlated. Because we were the biggest economy, we were the strongest economy, we were the fastest growing economy, right? So when the U.S. is doing well, everyone else tended to do pretty well too, because we were bigger than everyone else, and because we tend to import more than we export, right? And that's this is a topic for another day, but we're not going to freak out about that right now, because that is also what you have to do if you're the global reserve.
So you're not blaming past presidents for that.
If you're the global reserve currency, you actually have to have a trade deficit.
Right.
Now, how much of it you have, that's a different question, but you have to have a trade deficit. So anyways, back to that. The global economy was very much in line with our economy. So you really could get away with kind of just knowing what was going on here and invest sort of according to that. Plus, there wasn't that much that was super exciting that, outside of our economy that was really worth putting the time in to understand. For the average investor, you could do it, but you didn't absolutely have to. It wasn't like you were going to make it. It wasn't necessary. But now that's changing, right? Now, very quickly, China is becoming the much more of a dominant force in the global economy.
Well, I think some of the stuff that we've written about, you've talked about this too, is when we take a look at the changing landscapes of mobile payments and how in a country like India or China, or even when I was in Singapore, how they default to mobile payments, where the adoption here is still in its relative infancy for them.
Yeah, they're leapfrogging a lot of our technologies, but they're also, the sheer size of their economy is really going to change the global economy and the dynamics of the global economy.
What's the one country to watch, you think, over the next couple of years as that will be the driving force, not today, but in 5 years' time?
I think many people would say China.
Mm-hmm.
Well, just this week, something happened in China that I think should give a lot of those people big time pause for concern. China basically just made their ruler a king for life, right? They removed the term limits. So this guy, Xi Jinping, is going to be there for life, essentially for life. Now, the problem with that too, forget anything you might think about like China and their form of government and what this guy's personal goals are. History shows us that it never really goes well when you remove any kind of accountability from a person or a group. And by having this guy, can stay there for the rest of his life, that means basically accountability is pretty much gone.
Correct.
So I think that you add that to the demographics of China, that China is going to, the phrase is like China's going to get old before it gets rich.
Well, I mean, they are dealing with the same aging of the population that we are.
Yeah. Yeah. And they face it at even more difficult times because they haven't gotten to that per capita GDP before they're going to have that kind of tipping point where that pyramid, right? The percent of people who are older is going to get really ugly. The country that I find really, really interesting is actually India, because India is so young and it is such a freaking mess, which is awesome, because when you have something that is that bad, little tiny little incremental improvements can have enormous impact, particularly when you're dealing with a population that is that big and that young.
Correct. I mean, we've heard a number of different companies, and I think the one that stands out the most on their earnings call that have sung the praises, or the potential, I should say, of India is Apple. And it's no secret that they are pushing into there, as are Facebook, as are Google, and the others. I think you're spot on. I think that is the country to watch. And I think I saw some statistic that said that by, I want to say 2025, maybe 2026, India will actually surpass China in terms of global GDP contribution.
Well, and one other thing to think about, just between the two of them, something that most people don't think about, because, again, as long as all of us have been alive, the U.S. has been, number one. But for thousands of years, China and India combined represented more than 50% of global GDP. It's only been since the Industrial Revolution that the Western world really dominated. And we're now switching back to, during our lifetime, we're kind of seeing that switch back to where China and India are going to again take over. And it's a game of numbers. They just have so many people.
So if we were to put that in our thematic lexicon, you're talking about the middle class squeeze and the decline, whereas outside in countries like China, India, and others, maybe Africa, we're seeing the rise of the new middle class.
When you have a very poor economy, you tend to have a very small number of super rich people and an enormous number of super poor people. Because a emerging economy, they tend to not have super stable law, super stable government, very efficient financial markets, right? So that makes it very difficult for people to improve their lot in life. Because there's not a whole lot of avenues for that. So you tend to see lots of poor people, and then that handful of people who control most of the resources, right? And as an economy develops, moves into the modern era, you start to see that rise in the middle class, which is exactly what we're seeing in these emerging economies. Now, in the more developed, in the Western world, what we're seeing is that stagnation, because as we've talked about all the time, the potential growth of an economy is a function of the growth of the labor pool and the growth of productivity.
We don't talk about that. You talk about it.
Never. We have two really tough headwinds for that for the developed world. You don't have a rapidly growing employment pool, right? The labor pool is not growing quickly, whereas in these emerging markets, it really is.
Well, what is our labor force participation rate? 65, 66%?
Yeah, it's well below where it was in its peak, and it's just not going to be moving real fast.
Exactly.
Then you also have the problem you have with productivity. The productivity gains that an economy can benefit from, when you take the vast majority living a generally rural agrarian life and you put them into office buildings where they're working, in much more sophisticated ways. That's a massive leap. And that, if that happens over just a couple generations, that is an astronomical improvement in productivity levels. Well, in the developed world, what are we going to do to have that delta in improvement? It's you need a massive technological advancement. And I don't see that on the horizon, to have something that's going to really leapfrog our productivity, whereas these countries do. And in here, what we're facing is that, slowing workforce, weak productivity. And when that happens, everybody gets real stressed out, right? It's like, things aren't working. We're not growing like we used to, right? So everybody gets all nervous. And now you start to see government start clamping down, because everybody looks at government and goes, what the hell? This sucks. Things aren't the way they used to be, right? When
I feel like I'm listening to Fox News when you say all that.
That this sucks?
No, I guess what I'm saying is that, what you had just said is that, knowing that we're going to have a tougher time, that we tend to get almost a protectionist mentality, it sounds like.
Exactly. And that's kind of something that you see everywhere, right? You can see that in all these developed economies. When it gets tougher and tougher to grow at the rate that you were used to growing at, everybody freaks. And the government is like, oh crap, we got to do something.
Right.
And
Right.
normally the doing something means clamping down.
Right.
And then that clamping down tends to actually exacerbate the problems because you're not making it easier for new companies to start, for competition, for new entrants. You're making it actually harder. And then that tends to slow things down even more. That makes the middle class kind of shrink, because that middle class is usually a function of people solving problems in novel ways and creating wealth out of nothing.
So I don't want to put words in your mouth, but it sounds to me like you're in favor of, and I'm going to be trying carefully to say this, the right kind of immigration in the U.S.
The right kind of immigration is important for any economy that doesn't have its native population growing. Right. You know, I mean, Japan, unless you're going to be okay with GDP potentially even shrinking, like GDP not growing, but maybe per capita GDP is okay, right? Mm-hmm. We're sort of seeing that in Japan, because Japan's not real big on immigration, so they're really going to struggle there. You know, we'll see how they work that out. They are loosening up their immigration standards, but yeah, if you want really fast, if you want a rapid economic growth, and you can't really do that much with productivity because you're a highly developed nation, then it's a numbers game, right? You got to have more people joining the workforce. So.
Well, I would say it's simple math.
Yeah.
I mean, I hate to break it down to that.
Putting any politics aside, that's just kind of the reality.
Right. So I know you read quite a bit. Any recommendations to listeners out there who are trying to wrap their head around this and understand the economy better? Obviously, there's the book Cocktail Investing. Obviously, there is Tematica Research. Obviously, there is Subscribe to the Weekly Wrap and all that other stuff. But is there any starter books or great authors or columnists that you would say, yeah, you got to listen to this person?
Yeah, actually, there are, but there's, it depends on kind of what appeals to you most. So I think the best thing we could do is, in the write-up on this podcast, we will mention books and mention what it is that they're really good for, and give you guys links to them so that you can go buy them. Okay.
All right. And with just about a couple of minutes left, I would be so remiss if I did not steal a little bit from James Lipston, the guy who does Inside the Actors Studio. So, Lenore, I've got 7 questions for you.
Oh, Lord.
That will shed a little more onto you. Ready?
And this coming from the guy who loves nothing more than to see me blush bright red in front of other people.
That's because I don't blush. Here we go. Ready? Number 1. Right. What is your favorite word?
My favorite word? Pulchritudinous.
That's a very good word. Number 2. What is your favorite curse word?
Oh, well, that's easy. I mean,
we can bleep it out.
I'm Irish. Okay. And if you're Irish, you drop F-bombs like there's nobody's business. Okay. That's just what we do. I'm sorry.
That's all right. I
try to be delicate about it. My inside quiet voice.
We'll be diplomatic about it, so you don't have to actually say it. We'll go with F-bomb. Number 3, what sound or noise do you love?
Oh. Okay. Absolute favorite is in spring, the sound of birds early in the morning. Just that soft little sound, because it's like it's such optimism, right? It's just everything starting. It's just the sweetest sound.
Okay. What profession other than the one you have would you like to attempt?
I always wanted to be a fighter pilot. Seriously, I did. I got into Annapolis, but I have.
See now that's revealing. Nobody, and not even I knew that. See that?
Yeah. Really wanted to.
All right. Number 5. If heaven exists, what would you like to hear God say when you arrive at the pearly gates?
Well, I would prefer he doesn't say get out.
So something along the lines of, "Wow, you made it."
You know what I'd like him to say, "Well done."
There you go. Nice little hat tip. Okay, and then the last two are kind of in keeping with Cocktail Investing, the book, and the name of this podcast, Cocktail Investing. Number 6, favorite cocktail.
A very, very dirty martini.
How many olives?
I've gotten greedy lately. I used to be like 3, and now I'm kind of, I've my martini has sort of merged into a snack bar.
Okay, all right. Now, so with that in mind, 6A, what do you stuff your olives with?
Blue cheese.
Okay.
And if I can't have, like, truth be told, blue cheese, it's got to be blue cheese olives. If I can't get that, though, I have learned, because in Italy, they look at you like, what the hell are you talking about? I've learned to really like these little tiny, the cocktail onions that have been soaked in vinegar.
Oh, there you
That
go.
is not too shabby.
Okay, and then number 7, and I think this is going to be probably the most difficult question for you to answer.
Yeah.
Favorite wine?
Barolo.
No, that's a category of wine.
Favorite? Oh, you mean the specific
yes,
wine?
yes.
Oh God, you know what? I couldn't do that. That's like asking me to pick one of my favorite children. I love them all.
All right. So
many, actually, I will say, because there's also Bordeaux that I just love.
Okay.
Yeah, I don't think I could narrow it down to just one, because that would be like, that's the one you have to stick with. Like, no, I like the variety.
All right. Lenore, I'm going to steal a line from my old podcast, which is, before we get out of here, and you've been so generous with your time as we've turned the microscope onto you, is there anything we didn't talk about that we should real quick before we get out of here today?
Yeah, I think the big thing, if you're going to be looking at if you're trying to look at the economy and using that to help you make your investing decisions, know what thesis, like actually write down, because it's this stuff, these big picture things are it's easy to think that you know what you're thinking, but you've just made a bunch of assumptions, you're not clear. Actually write down, like, here are the things that I think are true. And then look at all those and say, okay, well, how could I find out I'm wrong? Like, what are things, what could I see to say I'm wrong? Because the big thing with investing is how do I know that I'm right and how do I know that I'm wrong?
Right. So this is not like a sheet of paper. This is more like a notebook.
Yeah. And keep looking at it. Like, keep looking at, month after month. Here's my like 5 hypotheses of what is true. And month after month, keep looking at them and going, yeah, are those still true? Does that still pan out?
All right.
Because things change. It's always changing.
Well, I think as we wrote in the book, investing is more like a movie with a lot of plot developments, turns, weaves, not a snapshot in time or a photograph. And I think you're exactly right on that. You got to be able to trace back, see what and the nice thing about doing something like that is it allows you to have positive confirmation, but it also helps you realize where you were wrong, or maybe you didn't read the data the right way.
Exactly.
All right. Well, that's our show for this week. And next week, I'm afraid to say it is I who will be under the microscope. Lord knows what I'm going to be asked.
Revenge is mine.
All right. Well, thanks for listening, everybody.